VUG crashed harder but recovered nearly 2 months faster. That's the kind of bounce back speed that changes portfolios. VUG recovered 58 days faster. That's nearly 2 months of gains IUSG investors completely missed out on. IUSG pulls ahead with 23% returns versus VUG's 19%, a solid 4-point lead over 12 months. IUSG crossed the finish line 4 percentage points ahead over 1 year. Same track, slightly faster engine. Think race cars with just a bit more horsepower. The VUG edges out IUSG with 99% annualized returns versus 94%, a solid 5-point lead over 3 years. Over 5 years, they're basically twins. IUSG hit 96%. VUG delivered 94%. Nearly identical performance here. After 5 years, these funds finished nearly neck and neck, just 2 percentage points apart. Like marathon runners, it's not about who sprints fastest, but who endures best. IUSG's Sharpe ratio of 0.9 beats VUG's 0.7, delivering better returns for every unit of risk taken. IUSG's downside protection edge is clear here. It's delivering better risk-adjusted returns when markets drop. Risk-adjusted returns are like a report card. IUSG scores higher grades with the same effort, delivering better results per unit of risk taken. VUG's steeper drop means higher volatility, but that same risk profile helps it bounce back faster during recoveries. VUG bounced back nearly 2 months faster. That recovery speed matters when you're waiting to break even again. VUG's deeper 6-foot dive means bigger losses during downturns, but that aggressive nature also powers faster recoveries. Classic high-risk, high-reward swimming pool dynamics here. IUSG spreads your money across 463 stocks. VUG's just 163, meaning it's way more concentrated and riskier. IUSG's 463 holdings spread your risk across way more companies than VUG's 163, like splitting eggs across hundreds of baskets instead of just over 100. VUG goes all in on tech at 51%, while IUSG takes a slightly lighter approach at 47%. Here's the tale of the tape. IUSG wins on risk protection and diversification, while VUG dominates on raw returns and recovery speed. IUSG doubles down on financials at 10%, while VUG keeps it light at just 5% allocation. VUG loads up on tech like extra pepperoni, while IUSG spreads the toppings around to banks and financials. Same pizza, different slices for your portfolio. IUSG's 36% turnover means it's trading actively, 7 times more than VUG's steady 5% approach. Both funds charge exactly 0.04% annually, perfectly matched on costs, so fees won't decide this battle. IUSG's engine revs 7 times harder with more turnover, yet maintenance costs stay identical. Sometimes the busier car costs exactly the same to run. VUG's 5% turnover keeps your tax bill tiny, while IUSG's 36% churn generates way more taxable events. So which ETF fits you? IUSG's for stability seekers, VUG's for those chasing maximum long-term growth potential. Think of IUSG as a steady rocket climb, controlled and predictable, while VUG ignites everything at once for explosive height. Same destination, different G-forces you'll endure. Standard disclaimer here. Don't treat this as financial advice. Do your own research always. Want more ETF battles? Hit subscribe for weekly breakdowns with real numbers and no fluff whatsoever.